everyone, we are Hotel Team 5.3.
I'm Yijen. I'm going to give you a brief introduction, finished by a recommendation.
I'm Xiaoling. I'm going to talk about the quarterly performance during the whole year.
And I'm Constanza, and I'm going to explain to you the overall performance of our hotel.
I'm Mei-Ling. I'm going to talk about the findings and analysis part 1.
I'm Tianli. I'm going to talk about the findings and analysis part 2.
To our management team, we are going to take a deep look at our performance over the last 12 months. Then we are going to analyze it based on the findings and analytical data, followed by a recommendation for our future strategy to stimulate our hotel's overall performance and subsequently increase revenue. The background of our hotel. Our hotel opened in 2009 is a 4-star full-service business hotel, ideally located in the city center on a waterfront site. It offers 250 rooms, including 50 premiums and 200 standards. All of them provide the discerning travelers a host of facilities. Our restaurant has 125 seats with a drawing 50-seat bar lounge section. Guests will also appreciate the leisure and entertainment facilities in the hotel itself, such as 2,000 square feet of conference and event space, 1 bay exercise room, and a small pool and outdoor recreation area.
About our second part, the overall performance. Based on our quarterly performance, we picked ADR, RevPAR, and occupancy as our reference. Start with occupancy. As you can see here, the first quarter we had 54.8% of the occupancy rate, and comparatively higher than the average of our competitor. And after the quarter 1, our occupancy kept increasing and reached 77% in the quarter 3. So during the whole year, our NPI was higher than the average of our competitor. Even we had comparatively higher occupancy than the average, our ADR didn't reach our expectation. We had average of 149 ADR in the quarter 1, which is almost 10% lower than the average in the market. But the good thing is that our RGI is just the average of the market. And by the following 6 months, the situation was worse for us because in the quarter 2, our ADR decreased more, and in the quarter 2, increased less than our competitors in the market. But our business back in track in the quarter 4 because our ADR increased $2, while at the same time, our competitor decreased $9 from quarter 3. As I just mentioned, even we had average of RGI in the first quarter, but in the quarter 2 and quarter 3, our RGI kept decreasing, especially in the quarter 3, because with the high season, our occupancy is the highest and also the competitors, but due to the low ADR of our hotels, our RGI was almost 10% less than the average in the market. And after quarter 3, our RGI climbed back to the average in the quarter 4. For the yearly performance, our NPI was about 6% higher than the average in the market, but our ADR was about 11% less than the average in the market. So reflected by the occupancy and ADR, our RGI was 5% lower than the average in the market.
For our overall performance in 2017, you can see that our total revenue was of $9,782,860, and our total costs were of 87.55% of our revenue, while our net profit was only of 12.45% of our total revenue. This is due to the fact that we spent too much money during the year, and that didn't allow us to be as profitable as we could have been. Now, for our yearly business performance, you can see that our rooms market share was of 13.14%, which was also the second highest of our competitive set. And this can be given by the fact that the strategy we applied was of lowering rates to increase occupancy, while our ROE was only 4.64%. And this means that we weren't as profitable as we could have been with the money invested by our owners. So here you can see our yearly revenue and profit. As you can see, our peak of revenue was in August, and as well in profit, while our lowest revenue was in January and our lowest profit was instead in February. The slight rise between January and February in revenue can be due to the fact that we decided not to apply anymore the rate parity between the distribution channel, while the decrease in profit can be explained by the fact that to increase our guest satisfaction index in facilities and services, we spend too much more money in that. So here you can see our yearly occupancy. As you can see, our peak was again in August, which can be given by the fact of the high season, and our lowest occupancy percentage was in January. However, from January until April, we had always a steady increase and a very, very slight decrease from April to May, just to increase a little bit at the end. From August instead we had a decrease in the occupancy percentage, which can be due to the fact that we raised our rates and also by the fact that we reached a lower season. Now for our yearly market indexes, so ARI, MPI and RGI, you can see that based on the baseline, we weren't as profitable as we could have been. Our ADR were way too low, and as well as our RevPAR. However, our very low rates allowed us to have higher occupancy compared to the market. In fact, we were always above the baseline on occupancy percentage. Now for RFPs. So during the year, we received many different group requests, and our rates were all rejected. So in March and May, the rates we applied were way too high compared to the market. However, from June, October, November, and again in November, the rates we offered to the group were quite low, and we believe that having offered to the groups a lower rate wouldn't have allowed us to be as profitable as we could have been anyways. So we believe that not having reached the group for those months wouldn't have been a big deal, because our revenue would have anyways decreased drastically because of the low rates applied.
Analysis and findings. During the first quarter, we focused on investing in reimbursement that we considered as the most important for our target market. We invested in making contracts with companies for cleaning contracts on premium and standard rooms, meeting rooms, lobby and public areas, front desks, and associated facilities. We didn't invest much on facilities as we spent a lot on reimbursement and services. So guest satisfaction on facilities is a bit low, which is lower than 10%. But the service satisfaction has already reached 50%. In the second quarter, we shifted our attention more in line with our value-based strategy by investing more in additional services, such as a bar lounge, parking, grounds, pools, restaurant, and environmental program. In order to increase our reputation, we also invest more in the facilities so that the guest satisfaction raised to about 70%. For the third quarter, we had a lower demand as there was a case that a technical problem happened in our hotel, and we were obliged to pay $40,000 on soft redo for our meeting rooms. So the quality dropped a little bit. Then later we tried to invest on soft redo goods on facility and environmental program to rescue our reputation. And in the last quarter, we remained a constant investment in the soft goods as we did last quarter. We highly recommended our hotel to invest more fully and deeper renovation as we renovated the front desk. Therefore, finally, we ranked the highest in facilities and services satisfaction, which is almost about 80%. And this is a reputation management chart. And from this chart, it actually it measures the average of all of these reimbursement and facilities investment, which compares our hotel with all the other hotels. We can see that our reputation percentage is really high during the first half year, but because of the case that happened in the third quarter, we dropped to a very low point in August. But we tried to save it by investing on the renovation, which finally helped us to get back to the average and get a high score in the overall average.
Hotel has 4 distribution channels: direct, GDS, OTA, and wholesales. From the comparison between these two charts, which indicate the marketing expenses and the profit contribution separately over the year, we can see that it is a little bit tricky since we deducted our overall marketing expenses in April due to our incoming shortage, but the profit contribution still increased slightly. However, when we deducted our expense again in October here, the profit contribution decreased. Hence, the relationship between marketing expense and profit contribution was not linear and can be difficult to forecast, which might depend heavily on other factors, such as the room rate, the intensity of competition within the market. Thus, we will keep the marketing expense more stable next year to avoid overinvestment, since the impact of it on profit is not predictable. Compared to last year, the distribution of profits among different channels are roughly reasonable. We can see that the direct channel still generates the most profit from different segments here, and the performance of OTAs and wholesales are close to each other and at the bottom, and they are the 2 least used channels last year. Speak about the occupancy rate among this year, we can see the trend of the weekday occupancy and the weekend occupancy are roughly the same, but the monthly occupancy of weekdays are always lower than the weekend occupancy. However, we can notice that the weekend occupancy rate was getting closer to the weekday occupancy between May and July. This is due to our adjustment here. We decided to lower the percentage of rate increasing when booking exceeds 95% among weekdays and increasing it among weekends, since we want to encourage more daily weekday booking and attract more business travelers, our major targeted customer segment. And here's market penetration index among 3 major segments in the industry. They are transient, discounted, and group. Last year, we can see that our occupancy among the transient and discounted groups are generally higher than the industry baseline. However, the occupancy of group fluctuates a lot above and below the baseline. We compared our average group rate with our competitor performance in order to draw an average rate index here. The data of January and October is missing here, since we did not invest in the performance benchmark surveys these 2 months. But we can still see that our average group rate is generally lower than our competitor, since all ARI data we have is below 1. And we can't find explanation from the reputation management chart as well, since between March and November, our line interacts only once with our competitors here, but the group occupancy fluctuates several times. In conclusion, the fluctuation of group occupancy might depend on the external market condition instead of the competition within the industry, and we are going to focus more on it next year in order to find the exact factors driving
our recommendations. Since the room rates were too low to balance the expense on the maintenance of the facilities and service, we decided to, in short term, we are going to adjust the price strategy to increase revenue, relying on the market forecast to effectively adjust price and marketing expenditure. We will target group rates as well to boost the secure occupancy rate by analyzing forecasted demand for weekends and weekdays according to seasonality. Last, we will reinforce the trigger point with better understanding of the general market target customers' booking patterns. In long term, we will introduce loyalty program to secure existing customers and attract new customers, in addition to constantly delivering high standard service to strengthen hotels' reputation. We will rearrange facilities, which means that we may consider terminate unnecessary and unprofitable facilities to better distribute the operational capital. Not least, We will dedicate more resources to the technologies that enable guest interactions, improve the online search and booking experience, as well as the system that support these touchpoints.
Thank you for watching.